Well, we keep talking about the accounting cycle and acting like we're finished, and I keep adding a step, and I'm going to add one more step, but promise this really is the last one. We talked about retained earnings is exactly that. It's the earnings that are retained by the company. And so far, to get our net income into that ending retained earnings, I just drew a big old arrow and said, net income goes to retained earnings. Well, we've got to make our books reflect that. So we've got to get that general ledger where we have every account listed. We have to get that fixed before we begin a new year. And that's what closing is. We've talked about, you have journal entries. You post those to the ledger, then you do a trial balance. Then you do an adjusting journal entries and you really post those as well to get to your adjusted trial balance. Then you do your financial statements, and I kind of acted like we were done, but we're not. We have to do these closing entries, and then we'll do one more trial balance just to make sure our debits still equal our credits. All closing means is to zero out what we call our temporary accounts. Our temporary accounts are anything that goes into your net income. That's your revenues and your expenses. So in essence, you want what's on the income statement to end up in retained earnings. The other account that we want to close is dividends. Remember, this is what the company distributes to the owners. It's in essence the earnings that is not retained. Retained means stays in the company. If you pay something out in a dividend, you're sending it out of the company back to the owners. So that's why this was kind of our first little contra account. And it was a contra equity account, which meant it was equity with a debit balance because it reduces your equity. That makes permanent accounts things you don't zero out. You just let them go from year to year to year. Since this is all the income statement accounts, these must be all the balance sheet accounts. These are your assets, your liabilities, your stockholders' equity, except for dividends. Those are your balance sheet accounts. We want the assets that we bought 6 years ago still to show up in our accounts up until the time we sell them. So we do closing entries on December 31st. The process is 4 journal entries, but 2 steps. We want to move our dividends to retained earnings. And then you want to move your net income to retained earnings as well. But we don't have an account called net income yet. First thing I like to do is close my dividends because I always forget to close dividends. Notice I've got dividends here of $15,000. To get that, the entry that I made was I debited dividends for $15,000 and I credited cash for $15,000. So I have a debit balance sitting here. To close, I want to do whatever I need to do to make that zero. To change a $15,000 debit balance to zero, I have to credit dividends for the 15. Dividends account had 15 here. I put 15 there. Boom, that thing's zeroed out. We're doing closing entries last of the year. I'm moving this to retained earnings. So retained earnings is my account, and that's 15,000. Should make sense that I'm debiting retained earnings because a debit to retained earnings reduces the account. Dividends will reduce retained earnings because they're the earnings that are not retained. Then you want to go through your trial balance and find all the revenue and all the expenses. Remember, unearned revenue is a liability. That's one of our adjusting journal entries where we owe people goods and services. So don't let that word revenue throw you. That's not a revenue account. Really, our only revenue account is the service revenue. It has a credit balance. So to zero that out, I'm going to have to debit it. I need to do the opposite. Well, I said you almost always increase revenues and increase expenses. This is the one time you don't because you're zeroing them out. 63.5. We're going to take that to a special account called income summary for the 63.5. We're going to have this income summary account, and this is the most temporary of temporary accounts. It exists for, if you have a computer, seconds. Companies will have hundreds of expenses, and they might have dozens of revenue accounts. And we don't want to clutter up our retained earnings with all these entries. So we want to do it in one fell swoop into the retained earnings so that I know what's my earnings, what's my dividends for a particular year. So I'm going to use this little income summary as a holding account. We're going to do the same thing with expenses. We're going to close those as well to income summary. Zero stuff out. Salaries expense got a debit balance. To zero it out, I have to credit it. So salaries for 11.3. Make sure you get things on the right side. Insurance expense, interest expense, 500. Depreciation expense, 5,000. Supplies expense, rent expense, 4,000. I'm going to take all those accounts and take them to that magic income summary account. I'm not too great at making up names. This is the summary of your income that's going to be in that account. Total all those up and you come up with 27,050. And always when you get a number, kind of look like this has got a 50 here. And so my first thing I look through and say, okay, there is a 50 there. Because the first time I looked down, I thought, well, wait a minute, there's no 50s. How can that be? So do kind of look through and make sure that, 27,000 looks about right. So when I'm done with that, all of these expenses are zeroed out. This revenue is zeroed out, and these dividends are zeroed out. If I look at my income summary account, I put in 63,500 with revenue. I put in 27,050, or if you remember on the T accounts, if they're on opposite sides, you subtract them. So that gives me a balance on this side of 36,450. That must be my net income. I should be able to check my income statement and make sure that's what I showed for income. Otherwise, something's not right. What I want to do is close out this account as my last step. It's got a credit balance. To get rid of a credit balance, it has to be debited. And that goes to your retained earnings. So rather than drawing a big old arrow and saying all our revenue and expenses, our income goes to retained earnings, that's how we get there. This should make sense that it's a credit because I had income, and income should increase a stockholder's equity account. At the beginning of the next year, you're not 21, I think I moved you to 22. On January 1, what's your balance in dividends, sales, and salaries expense? We zeroed this one out. We zeroed out all the revenues accounts, and we zeroed out all the salaries expense. So when we start the year, we start those fresh. So when I make my first sale on January 1, that will go into my sales account, and I'll know exactly how much I make in a particular year. Otherwise, you just drive yourself nuts. You'd have to start every year subtracting the total balance at the end of the year from the balance in the beginning of the year, figure out what your sales are. It would drive you even battier than what maybe closing entries do. What's the balance in retained earnings on January 1? Notice I had a beginning balance of 3,500 and it's credit balance. So I started out with 3,500 here. I took out my dividends. I put 36 or 450. That was my income summary. You want to take this minus this plus this, or this. You come up with 24,950. Be honest with you, first time I did this, I came up with like 61,000. But you can tell these two minus that can't be 61,000. So do think a little bit about your numbers before you just leave your calculator. So this is what always goes on in your retained earnings account. You've only got 2 entries you ever make to retained earnings, and they always happen at the very last of the year. So the addition will always be your income for the year, any subtractions of your dividends. Let's say that next year your sales are 50 and we've only got 2 expenses just to make our life a little bit easier, and we do our dividends.
Go ahead and try this on your own. Just pause the video, then come back and check your answer.
So my retained earnings, going back to here, my ending balance in 2021 equals my beginning balance in 2022. Does that make sense? Now, whatever you have on December 31st is what you have on January 1.
So take a minute and complete the retained earnings, then check your answer.
Your retained earnings, you don't close. That just keeps growing and growing, hopefully, as long as you're making more income than you're paying in dividends.